Let me talk about some stocks, because this is much more interesting. And I'm going to talk about a global set of stocks. And I picked some names from the aggressive value portfolio that you've probably heard of at some point or other, or at least their products anyway. So the first one is a German company called Daimler AG. They make Mercedes-Benz cars. They also are the biggest truck maker in Europe. Now, let me tell you a little bit about the car business. It's not a very good business, right? It's cyclical. It's capital intensive. It's labor intensive. Labor unions have been known to be kind of aggressive at times. But the luxury car business is different. It's not like the regular car business. It's actually a really good business. You know, you get to price your products pretty much as the market can take. There's a lot of ability to differentiate your products. It's cool. It's fun. So Daimler, and if you're German, you have this panache, right? You have this ability to price your products in a way that nobody else can. Well, Daimler, they lost their way a long time ago. They decided to do something idiotic, which was to buy a volume car business called Chrysler, which is just stupid because that's a bad business. Why would you ever want to buy that? And then they got lucky and they got bailed out. A company called Cerberus, which is a private equity company in New York, actually bought Chrysler from them in 2005. And you can see, I'm going to use this cool laser pointer here. You can see on this chart that caused a brief spike in the company, but then the financial crisis happened and the company went crashing down. What you don't see on this chart is for years Daimler badly lagged BMW and Porsche and Audi and all the other European luxury companies in terms of not just their growth, but also the valuation of the stock, because they just got lost. They were focused on making cars for Chrysler. Well, anyway, finally, the characters that were responsible for this got kicked out. The other thing about car companies that is interesting, I guess, if you're an analyst, is that it's a slow business. Product cycles are long. The products that Daimler or any other car company right now are selling, they were in the R&D labs 4 to 7 years ago. So changing a model lineup takes time. Well, anyway, I like cars a lot. I follow the business closely. And there was clear change afoot. And the big change afoot in the luxury business is that small cars are actually profitable. So this is one that they just started selling this just a little while ago. They had a lot of ads during the Super Bowl. They're called the CLA. There's a whole bunch of other small cars they're going to be coming out with shortly. And when you can sell a lot of small cars, you can amortize a lot of your overhead and your parts and so forth over a much larger base of cars. It's very profitable stuff. We bought Daimler, actually it was in late 11, I think we first got involved, and then we bought a whole bunch more right about there. And the relative value part comes in, this blue line, that's price to sales. Earnings are hard to predict for car companies because the margins they just flop around all over the place. But the sales are a little more predictable. This was basically the very low end of the long-term range. It started to revalue. You can see it's done very nicely. But we think it's got a ways to go because they've got a lot more small car models coming out. Okay, enough about Daimler. Next stock is a company called Eris Group. Now, you probably never heard of them. They are a little company. They're out in Georgia. And they have historically tried to compete kind of down market of Cisco. They make networking gear, but it's kind of cut price stuff. It's not exactly top drawer. You can imagine that's not the easiest business to be in, but they were a long-term survivor. They did a pretty good job in terms of product cadence and in terms of their cost controls. And then something interesting happened. Motorola, which makes set-top boxes, among other things, got bought by Google because Google wanted Motorola's treasure trove of patents. They really weren't interested in the physical production of anything. And then after Google bought it, they said, well, what the heck do we do with all these set-top boxes? Geez, we don't want to do this. Well, let's get somebody else to do it. So they sold it to Eris for not a whole lot of money. And that happened right about in here. And that's why the price to earnings dropped so low, because all of a sudden they got all these earnings from set-top boxes. Now, your set-top box, I'm sure almost all of you have. Right? I mean, you can't watch TV without it. And there's a lot of stuff actually happening in the world of set-top boxes. It's quite interesting because you're starting to get things like Netflix and probably a whole bunch of other what they call over-the-top services where it's not really a cable show you're watching, it's a Netflix show. That's all coming through your set-top box. So in my world, sometimes the things where you can't exactly figure it out. There's a certain, as they say in French, je ne sais quoi factor associated with the device. Those are interesting things to be involved with. And here's this company that just got handed basically 50% market share of the US set-top box business. I thought that sounded pretty interesting. So we bought a whole bunch of it in here. You can see the stock kind of went nuts later in the year. People figured this out, and we have sold some of our position off, but I still think it's interesting. I don't want to quite give it all up just yet. So third position, this is where I can do my little hedge fund tricks. This is a company called EMC. Some of you have probably heard of it. They're the largest company in the technology world for enterprise storage. So big companies, medium-sized companies, they generate tons of data. They got to stick it somewhere, so they store it on these big refrigerator-sized boxes. Once upon a time, back in the bubble of the 2000s, this traded for like 12 times revenue and 100 times earnings when people thought that this would just go to infinity. Of course, that didn't really happen. The stock price collapsed. The valuation collapsed. EMC is an interesting situation. It's what I call parent-subsidiary arbitrage. They have a company that they own called VMware, which you may never have heard of, but they make software that virtualizes server and computing environments. So basically, you can take a whole bunch of servers and run them as one server by partitioning the bigger server out. Huge savings in terms of cost and ease of maintenance and a whole bunch of other things that geeks care about. Anyway, VMware trades separately, but EMC owns 80% of it. So in Value World, one of the things we like to do is something called sum of the parts analysis. You add up the parts of a business, you see what they're worth, and you say, do I agree with this analysis, or maybe is this off? Well, in EMC's case, and I hope you can see this well, if you can't in the back, sorry about that, but most of the value of EMC is worth about $50 billion. 30 of that 50 is VMware. And then there's cash, there's a lot of cash. There's a company called Pivotal that they're going to IPO. We're missing a zero here, but that's worth about $5 billion, we're guessing. So if I take the value of EMC and I strip out this funky virtual machine business, cash, this thing that they're going to IPO later this year, I get $1. There's an expression, something, it's only $1. So I can go long EMC and I can go short shares of VMware, and I create this stub that is worth like nothing. So all I have to do is just kind of wait around. Basically, this seems irrational. This hasn't, by the way, worked yet. This is just something in the portfolio currently. All right.